How do student investors tell real versus perceived risk? Imagine you're about to make your first investment and feel a mix of excitement and worry. How do you know if your fears are real or just in your head? That's what we're here to figure out. When students start investing, they often get confused between what's actually risky and what just feels risky. Real risk is the chance of losing money or not reaching their goals, based on facts and data. Perceived risk is how risky something seems, which can be influenced by emotions, stories, or misinformation. To tell the difference, students first learn the basics about risk and return. They understand that higher potential gains usually mean higher chances of losing money. This is called the risk-return trade-off. Knowing this helps them see risk as something measurable, like how much prices fluctuate or how economic changes affect investments. Students often overestimate risk at first because they are new and emotional. For example, they might panic after a small loss, thinking the whole investment is doomed. This is called a cognitive bias. As they gain more experience, they start to see the actual risks based on facts. They observe how markets move and how investments perform over time. This feedback helps them adjust their feelings and see the real risk more clearly. Practical steps include learning about different types of investments, like stocks, bonds, or mutual funds, and understanding their typical risks. They can also use tools like standard deviation to measure how much prices change, or beta to see how sensitive an investment is to market movements. Starting small with diversified investments is another good way. It allows students to see how markets go up and down without risking too much money. Reflecting on their investment results helps them learn what was real risk and what was just fear. They also need to watch out for psychological biases like overconfidence or fear, which can make perceived risk seem bigger than it really is. In the end, student investors tell real from perceived risk by sticking to facts, understanding the basics of risk and return, and learning from their experiences. This helps them see that risk is part of investing but can be managed. The more they learn and experience, the better they get at telling what's truly risky and what's just a feeling. This process makes investing less scary and more about making smart choices based on real data.